Kerwin, welcome to the stock market session 3, part 2. How are you?
Doing well.
Last week I was trying to remember the 10th criteria to stock selection. It's share price, and the share price has to be $50 to $100 plus, which is to say that a $10 stock gets no respect. Please understand. $20 stock, $40 stock gets no respect. Only after between 50 and 100 does it at least get like the eyes of these shareholders, that these investors, traders that are looking for those higher share prices. Because why? Because the stock is favored. Because the stock has gone up and up, proven itself. No penny stock will ever get respect. Okay. So that's important. So to review, I might got this on recording. Welcome, listeners, if you're listening. Number 1, 10-year chart. Number 2, volume. Number 3, PE, showing profits. Number 4, dividends. Number 5, cover calls, 3% return a month. Number 6, stock splits. Number 7, can it double? Number 8, new high. Number 9, market cap, 50 billion plus. Number 10 is the share price. So these lower price stocks do not get the check mark. High price stocks, and if it's $600 or $700 a share, even better, because those stocks are even higher, more highly rated, right? They're looked at like, gold is more expensive than lead. The fine wine costs more. Okay, think of it like that. And you'll hear people say share price doesn't matter. Share price matters, just like size matters. Share price matters. Okay, and then 11, I have, can you buy the product? Make sense?
Yes.
Hey, okay. So the important thing about stock selection is like you're being a strategic, you're being a shrewd stock selector. You're not just buying any stock. It has to be something that has a lot of criteria. Because why? Because we have a strict criteria stock selection.
Right.
Give me 1 minute, please.
Okay.
So that's the 11 stock selection criteria, and I want you to be real strict about that. If you can get 7, 8, or 9 check marks out of the 11, you're doing pretty good. But you can't just buy anything. You can't just invest in anything. See the point? Am I coming through? Testing 1, 2, 3. Welcome back. How are you? Welcome back, Kerwin.
Thank you.
But you can't just buy anything. You can't just invest in any old company because you like it, because you like the name, because you like the product. We have a strict stock market selection. We have a strict criteria for stock selection. Is that fair?
Right.
Okay, so how did your trades go this week? Doing trades and successful pull the trigger?
Yeah. I got in Microsoft trade, one contract out to May. It's doing pretty good right now. I'm up 86% on that one, I think it was. I'm up 80%.
Microsoft shares or call option?
Call option. One contract out to May, to the May monthly. And then I got I jumped into Apple. I got one contract of Apple out to May as well. I don't know if that one is. I mean, it was kind of back and forth. It was up and it was down, and I guess some type of bad news came out Friday, and then it dumped the first part of the day, and then it kind of bought its way back up by the end of the day. So I mean, I'm down, I think like 8-9% on that one right now. So I think I ought to be okay.
Okay, give me the strike for the Microsoft and also the strike for the Apple.
The Microsoft is 440, and the Apple
40.
Let me look at the Apple. I can't remember right off the top of my head.
And then can you give me the current price on the Microsoft and the current price on the Apple?
Okay. You want a stock price or option price?
No, I have the stock price.
Okay. The Apple is 182.50 out to May, and the current option price on that is 169.
169. And then the 440 Microsoft.
Yeah, and the current option price on that one is 392.
I know you took a hit on the Apple one because it was down like 2 points when I looked at it.
Yes.
And you're buying close to the money, so I know you spent a pretty penny on that one.
Yeah.
How many contracts of each?
2 contracts Apple, 1 contract Microsoft.
All right. Let me make a suggestion. So we talked about when you're a professional or independent trader, you don't have luxury to lose a lot of money because you need to have money to trade, and you cannot ever go get wiped out, for example.
Right.
So we need to have hedges, protection. Okay. And one way to do that is so you have the Apple May 182.50, right?
Right.
What you do, you look at what you think the stock can go to. Do you think the stock might be able to go to 200?
Yes.
But not that much past 200?
Apple, yeah, I think it can definitely go past 200.
So what price do you think it probably will go up to maximum, being reasonable, 210?
Just kind of going off top of my head, yeah, about 210, 220.
All right, let's say 220. You said 220. Okay.
Yeah.
This is why I'm telling you, okay? Write down 220. May. And then Microsoft. What price do you think it can go to maximum by May? Just being reasonable.
450.
450. Okay, this is why. We're talking about insurance, when you buy a put, or if you short some shares, or if you put a hedge, which is
Right.
a spread, which is you buy one call and you sell the higher call. Right. So it's like insurance, you have some money coming back. We talked about just briefly the poor man's cover call, which is to own an option, to own a call option. And then let's say you own 100 strike. You sell the 110 or 120 strike. Because you're bringing in money on that call option. Okay.
Right.
Now, something to think about is you look at what price the stock may go to maximum, and that's just say with a reasonable move, meaning that you still want to get plenty of upside potential. I don't want to stop your potential in these options, but what I'm going to do, I want to reduce the chances of losing. Write this down. Reduce the chances of losing. Okay. So right now, anytime, but ideally when you start the position, but also like you can also always revamp the position. Sell the higher call. You own the lower call. You own Apple 182.50 times 2. You own Microsoft 440, right? Times 1. 450. You own the 440. Let's make it 460 because 450 is very close. Let's make it 460. That's a 20-point spread, right?
Right.
The 182 and the 220 is a 3750 point spread. 3750. Am I right? 3750 point spread from the 182 to 220. And the Microsoft is going to be a 20-point spread from the 440 to this 460. I'm counting the spread because I want to sell the higher call. Are you with me?
Yes, I'm here.
Okay,
Can you not see me?
So we own the 440 Microsoft. I want to sell the 460 to bring back money. I'm going to explain something to you. This is a powerful strategy. Okay.
All right.
Now, can we get a price? Are you able to get a price on the 460 at least when it was Friday?
460 from this past week.
Just from Friday, yeah. The price of the 460 call.
Let me look.
I appreciate you can look it up because I can do it also, but then you'll lose my beautiful face.
Right. No, I got you. Well, for next week's expiration.
No. This is May. This is May.
Oh, May. Okay, I'm sorry.
This is the same expiration.
Gotcha.
It's a one-time trade. It's just
455 is the expiration for May.
460.
Yeah. And the price on it is 455. Wait a minute.
That's not right. Calls.
Yeah. I think I'm on the wrong strike. I mean the wrong expiration date.
May 460. You told me the 440 was 392. Is that right? That might not be right.
Might not be.
You told me you owned the 440.
Okay, wait a minute. Okay, I'm with you. I got you. Okay. Microsoft is out to April. That's my problem. Yes.
Okay,
It's the
no worries.
April month. Yeah. Okay.
And you have the May for Apple?
Correct.
Okay. April. Is it the 440?
Yes, the 440 in April.
How much is it? How much is the one? How much is that?
And the contract on it is $395.
And then what's the share price, by the way?
$415.50.
$415.50.
Yeah.
And then what is the 460? What is the 460?
122 for the option.
Okay. Now, what you want to do as a choice is sell the 460. Okay, you own the 440, sell the 460, which creates a spread. Write down the spread. What does it do? It brings back money. It lowers your chances of losing. Because why? Because you cannot get wiped out now. That option that we know that we've had options that expire worthless.
Right.
Because that has happened, because that could happen, bringing back $1.22 is like saying there's no way we're going to get wiped out in this position.
Right.
If you did that for several trades, you'll have this extra money that you can do another trade. You can buy maybe a share of Microsoft. You see, it's a philosophy. And then where are you going to put that money? What if you sell these spreads? You made your call options in the spreads, brought back that money, and did what? Maybe bought some shares for long term, or you can even have the money there just sitting there, waiting for the next trade. You see?
Okay.
Now, what does it do to your position? you're technically short that 460 call, but you
Right.
own the 440. So what that means is this 395 call, I'm sorry, this 395 value here, it can go to what? It can go to $2,000. Write down 395 and then put an arrow and then to $2,000. Write that down. Or 20.0. Why? Because if you know how options work, if it's $1 in the money, let's say Microsoft is 441, that option will have $1 intrinsic value. Okay. Right now it's all extrinsic because it's all fluff, because it's all premium, because it's out of the money. And if you're at expiration today, it would expire worthless.
Right.
Correct?
Right.
And you have to really like appreciate that premium you're getting, because that premium decays over time.
Right.
I'm showing you to put it, turn it into a spread, and this is why, and I haven't even got to the punchline yet. Because your 395 value can go to 2,000, because why? Because it can go to up to 20 points, up to 460, and then have 20 points of real value. Don't worry about the premium. If it's the expiration date and your option is if the share price is 460 Microsoft, that 440 is exactly 20 points, which is $2,000. You follow?
Right.
That gives you plenty of play. Okay. It gives you plenty of play in the stock. Okay. Now, beyond 640, it's a wash. You're maxed out. You have a $2,000 maximum gain in this position, because you're short the 460. I'm sorry. Beyond 460, it's a wash, because you're short the 460. So while you're long to 440, you make money as it goes up. But once you hit 460, you're capped off, because the 460 you're short. So you're long 440, short 460. It stops at 440, beyond 460, and it's just a wash after that. They're gonna basically match up your options, and then they're gonna tie them together, and then they're gonna assign them that way, and your position will be like effectively taken out.
Right.
Okay. But what did you do? You have a 390, let's say $400 value right now, which is a good value.
Right.
Which can go to 20, which means you can go fivefold. Is fivefold a nice return?
Yes, very much so.
Hell yeah, it is. Hell yeah,
Right.
because why? Because 500%, or actually, if you think about it, 600%, because when it goes up from 4 to 8, that's 100% return. 12 is 200% return. 16 is 300% return. 20 is 400% return. Okay, so it's a 40% return, because it costs you. I'm counting the $400 investment, so it's really a 400% return. So the point is, you're still going to get plenty of play, and what you're bringing money back, right?
Right.
That's a powerful strategy I use. Not all the time. Only like if I really think it's gonna go bonkers, like let's say for NVIDIA, or like things that I think I really like for whatever reason, this option can really hit. I'm gonna play earnings. I need that earnings, whatever. Don't do a spread. But if you're just doing standard positions, think about bringing back some money, because one, you can collect that money for the next trade, and you reduce your chances of losing. I know you wrote that down, right?
Yes.
And it's income. It's income, because you have an investment. Now you're bringing in income.
Right.
And what? And you still have plenty of play in that stock.
Right. So,
any questions?
So let me ask you this. So I actually got in that contract at 254. So we're at 392 now. So how would that, as far as figuring it up from, since I got the 440 strike and we go and I buy and I sell the 460, would that matter?
No, because I already counted you had a profit. You told me you had a profit in it. I already counted that.
Okay.
And I'm counting from today. I'm counting today. It's $400. Yeah,
Gotcha.
you paid, how much you pay for it?
254.
Let's say 250. So if 250 goes to 20, that's more like what? 7 times, whatever that is,
Right.
whatever that times your investment. So it's even better. But I'm counting from today.
Gotcha.
400 to 20 points. That still gives you plenty of play, a nice return, and you're gonna get money back. So the chances of you getting wiped out in that position are 0.
Right.
I want you to think about that. Some investor traders will still get wiped out 100%, but you can't afford to do that. You're smarter. Okay.
Right.
Now let's do that. Can we do the Apple?
Yes.
Now here's the tricky thing about Apple. I know you have a loss.
Yes.
What's the what was the price you paid?
Let me go back to Apple.
I mean, do you know ballpark what you paid? $3, $4?
It was something like that. Yeah, I think it was around.
You went out to May.
Yes.
Now the news for Apple was some stupid bad news, like they're gonna have a revenue problem. I never look at the news. I think it's propaganda. I look at the trend, the volume. The volume's good. The trend is going up. What you have is just a classic drawdown or a classic dip in the stock, which is very common, and we're going to stay with it. Okay.
All right. Well, what made me go look because I was wondering why just about everything else in the market was skyrocketing and Apple was going down. I was just curious.
People are literally selling their Apple and buying NVIDIA and buying these other companies that are going bonkers.
Right.
And that's because they're trading. They're trying to do. But there's some investors to be like, Apple's cheap. Double down on Apple. You see, so you can play both sides. It has to do with your strategy, your goals, right?
Right.
So do you know what you pay for the Apple call?
It was around $4.20 or something like that.
Let's just say $4, $4.20. That's fine. It doesn't matter. What you got to realize is you're already at a loss. You already have it's already 50% loss.
Yeah.
Okay. Let's just face it. You put $100, you got 50. Okay.
Right.
Doesn't really matter that much that we're going to do a spread on it because we're going to get money back on it. Okay.
Right.
So tell me the price for the 220 May.
220 is 31 cents.
31 cents. Let's take it now. For 31 cents, it's almost not worth it. Let's take it back to. Can we look at the 215? Can we do the 215?
215, 44 cents.
Let's look at the 210. Can we?
63 cents.
Okay, that's a little bit better. And what I'm saying this is because I'm looking for a percentage return.
Right.
Okay, 63 cents. Because right now it's 169. Don't worry about the $4 you pay for it. Just look at what you have now. 169. Get back 63. That's like 1/3. Okay. See how I did that?
Yeah.
The 122 from the 395 is like 1/3 also. You see how I did that?
Yes.
So like write this down. 20 to 30% money back. Write this down. 20 to 30% money back on the spreads. Okay. And that it reduces your chance of losing. It nullifies the chances of getting wiped out. It brings some money in for the next trade. It's like a hedge, right down. It's a hedge. And if you can get and why did I do 210? Because look, Apple is 182 right now. You have to look at it where it is right now today, 182.
Right.
So your option, right, for the 182.50. Okay, actually, Apple's at 170 something. Sorry, what's Apple's share price?
179.
179. Your option for the 182.50 is kind of nice because it's kind of close to the strike price.
Right.
And if the stock does go to 210, I want to give you again. I don't want to cut your gains. I'm gonna give you plenty of play in the stock. Listen to my words. If Apple goes way up to 210, that option you have that's 169 right now is going to be you're going to get 1850 to go to 200, and then the 10 points you're going to get 2850 value. It's going to be worth $2,850, both of them.
Right.
So now we're at $5,700. Write that down. That's how much your option can be worth. Because why? Because the strike is 182.50. we know dollar per dollar at expiration, it's going to be that the value is going to be in the money dollar per dollar. So if once this Apple goes to 200, which it may go to 200.
Right.
That 182.50 strike is going to be 18.50 in the money. So it's going to be $1,850. Follow me. And then if it goes to 210, which gives you plenty of play, it's going to be $28.50 or $2,800. And then you have two calls, $5,700. You follow me?
Right.
Now, is $5,700 a nice return?
Very nice.
In one sense, you have to account for $400 what you paid for it.
Right.
Sorry, $800 because you bought two.
Right.
$840. Let's say $900. Let's say $900. Okay.
All right.
$900 to 5,700, which is like 9 times, like 6 times, 6.5 times profit. Is that fair?
Yes.
So I'm giving you plenty of play in the stock. However, you have to also consider that it's down to 169 now. So you really have to go by today. So you look at it, what price you pay for it, but also look at it where you are today, 169 to 5,700. Even better, now you're talking about 12 times your money. Okay.
Right.
So consider both what you pay for it, but also more importantly, Kerwin, where it is right now today, because we have to always count where we are today at the current price.
Right. Yes. So you say you don't do that on all positions. So you leave like ones you think is gonna run. You just buy a call and let them run.
Most of my positions, I do a spread because I want to always get that money back. I want to always get protection.
Right.
But if I really think this stock can run, if I'm looking to get a long shot, like I'm looking at earnings play, or for whatever reason I think it's going to go bonkers, I won't do the spread because I really think it can just go like unlimited up.
Right.
But that is, I know, let's be aware, it's unlikely. It's a long shot, and I only do that on very few positions, 10 to 20% of my positions. I say 80% of my positions, but 80% of my call options, or even puts, you can do it on puts too, are spread. I spread them like butter on toast. I spread them because why? Because I'm always looking to get that money back. I'm always looking to hedge to protect myself. So I'm not going to be out here losing 100% of the position because I don't have that luxury. I'm responsible. You're responsible. You're doing good trades.
Right. Yeah. Last what I think that was last May when the video really popped. I had a out the money spread on it. I think because it was at that time it was around like 280 or so. So I had a spread about 320 to 340, I believe it was, and it blew that out the water and it expired worthless. So
had you spread that, you would have got some money back.
Right.
Now, another thing you got to consider, we know that like 90% of the options expire worthless. We know that. And that's because people are buying lofty, way out there options,
Right.
And we know that on the other side of that, you have like what I call the house, the cover call writers, the people who own those shares, love to sell their options because they're bringing income.
Right.
They love to sell those higher price options because that brings them income. And we know that the stock's not going to always go up to that lofty price.
Right.
And that's why we can sell those options and bring in income because we know that Apple's not going to really pass 210 or 220. We know that Microsoft probably not going to pass to 460, probably not. Maybe if it does, well, we got our 5 times on our money, right?
Right. Right.
Is that worth something to you?
Yes, very much so.
Yeah, like if you think about like on a perspective, like you have your whole portfolio here, and you have 10 positions, and 8 of them you're bringing money back on those. Well, hey, that's going to pay some bills.
Right.
So like when you do a cover call, you have 100 shares, you write a cover call, bring back some money that's going to pay some bills. If you own the Microsoft 440 call, if you're on the Apple 182 call, when a 250 call. Let's bring some money back, pay some bills.
Right. You know,
Why? Because it's a philosophy. If you can pay out all these bills, you can pay your car note, your mortgage, your rent, your food. Quit your
right,
job. Join
right.
me in retiring to the stock market.
That's the goal, for sure. The you know, I got 700 shares of Palantir. I mean, I told you before. As far
By the
I
way,
still.
that's a nice little nest egg.
Oh yes,
I'm gonna write down 700 pounds here.
yeah, it's up nicely. I bought them at 13.94, so they're looking pretty good right now. But
I'm
I
getting
don't
like
know.
5% return on my Palantir monthly cover call. What about you?
So that's why I was just about to ask you. I haven't did a cover call yet. Is it a good time? Is it good to do one now? Can I go in say
Well,
Monday
if
and
you
do
really
it?
buy at 13, and what is it now? 20.
Yeah, it's like $25 somewhere around there. 24, 25.
I mean, you basically almost doubled your money.
Yes.
I mean, congratulations.
Thank you.
If you so let's just be real. Like, if you think it's going to go higher, then maybe don't do a cover call. But what I would do, in your position, I would do cover call maybe like half of them on 3 or 4 contracts. You see what I'm doing? That way, you can keep those shares open. Maybe 300 shares open, and do a cover call on 400 shares or 4 contracts. Can we look at so can we look at what's the share price? 25.
Yeah, something around there. I can get to it real quick if you want to know
And then
exactly.
let's look at April. It's March, so let's look at April cover call.
Price is $24.93.
493, basically 25, which is close enough. Let's look at tell me the call options above 25, and we're looking at April monthly.
So out to this is the monthly, right? Yes. So at the 26th strike, we got 152 and 158. The bid is 152. The ask is 158.
How about the 27?
27 is 118 and 123.
Stop right there. Okay, that makes a little more sense. Because why? Because you can still get 2 points share growth, 205. You follow me?
Right.
Write this down. Write the 27 times 4 contracts. 118, 128. Let's say put a limit order at 120. Okay.
Right.
Or just market it. I want to get you a few more bucks, but if you put limit at 120 or 125, it doesn't take. Just market it. Right. Let's say come tomorrow, Monday, you're gonna bring in, let's say 120 times 4 is $480.
Right.
And you're gonna sell at 27, which is a cover call for April, which is like 6 weeks. 6.5 weeks, which is great. Can we do an ROI, which is a return on investment percent? If you do 120 divided by the share price of $24.95, can you do that for me? What's 120 divided by $24.95?
It's like $24.95.
That's the share price. Yep.
Okay.
1.20 divided by 24.95.
Let me get the calculator. I'm good with the calculator.
See, I'm making you do your school, your classwork, like you're back in school.
Right. Look like it's about 4.8%.
4.8% return. How beautiful is that?
That's very nice.
So for 6 weeks. So look, with $480, what can you pay? Can you pay your car note? Can you pay what? Food? What's that gonna buy you?
I can definitely pay an electric bill, buy some groceries.
Yeah. Electric bill. I'm gonna write it down. Electric bill.
Buy groceries, put gas
Plus
in the car.
groceries.
Yeah.
Plus gas.
Yeah.
Look, so these 700 shares of Palantir you have, which are doing great. which had a great return. But yeah, you know what? Let's start capping that out. Let's start bringing in money on that. Because why? Because right now you're totally at risk.
Right.
And you know, and I know, and you know that Palantir can dump at any time because
Yes.
it's done that before. It's at 29, dumped at 13. Now it's back up
Right.
to 25. You'd be crazy not to do a cover call on that.
Right.
Now, me, I'm a little bit more conservative strategy. I would have been running cover calls from all the way from 13, just because I want to get every amount of cover call that I can get. But you're more of a aggressive investor. You just have those shares out there, you know.
Right. Right.
I don't want to take that from you. Let's just do half, right?
Okay.
Pay your electric bill, groceries, gas, get 480, and then just see where it goes. We're in a bull market, so technically, you don't want to cut your gains, but the income is how we live. So we need some income. Get some income on your call options, on your spreads up on top. I wrote on top of my page, up here on top of my page. Get some income on these cover calls and Palantir. But what? You still have plenty of play on these call options if it goes up. You still have some play on Palantir. You got 300 shares free and clear if you do 4 contracts at a 700 shares, not all. So if it goes to 30, you're good because you still have some nice play in those stocks. On the cover call, again, if you're at the 27 call, you have 2 points played. So $200 more per contract. You follow me?
Right.
Is the math tracking? Are we driving?
Yes.
So these are strategies which I think will help you when you start doing these trades. It's going to become normal to you, and you're going to just think about income, like bringing income. And I'll tell you what, Kerwin, it's not. I don't think it's the math that retires you into the stock market or pays you money or makes you successful. I think it's your mentality. I think like the power of the mind, the philosophy, the belief, the faith on what you're doing, your strategy.
I agree with that.
I told you last week. Go ahead.
What's that?
I think I told you last week. A wise man once said, if you don't have a goal, chances are you'll never get there.
Right.
So have a goal, you know. I want to bring in, you know, I don't know what your goal, $1,000 a month, $2,000 a month. Look, I got you 480 right here. Look, I got you 122 here in this Microsoft. Look, we got 63 cents per Apple contract, which is $63 because it's times 100 for a contract because it's denotes 100 shares per contract, right?
Right.
So not only to do these trades, bringing income, but repeated the same successful trades month to month are going to retire you in the stock market.
Right. Okay.
Now, what we didn't talk about, but it needs to happen also. You're very aggressive. You got these call options over here. You got Palantir shares uncovered, meaning there's no cover call. You also want to be able to pull the trigger. And that's a little more difficult. You said you had a NVIDIA option went to zero. It was nice money, went to zero, correct?
Right.
Make a plan. Pull the trigger when you have a decent profit or when you think you want to just bring it back in. Look, you're not always going to have a profit. Let's just be real. You're going to have a loss sometimes. I take losses also, obviously. But here's what I think I do that you don't do. When I have that loss in NVIDIA, or if it's not doing what I want it to do, I pull the trigger and take a loss. Why? Because what I do, let's say I spent 1,000, okay? And let's say we're into the closer to expiration. And now I'm kind of like, oh, down. I don't got much time left. It's only 500. It's only 300. It's only 200. Maybe it was 2,000. It went all the way down to 200. What I do, I pull the trigger, take the 200 out, take a loss. And if I want to keep going, I roll it back. Let me buy one that's 3 months out. Write this down. Be willing to take a loss. Be willing to take a loss, pull the trigger, And if you want to stay with that position, go out another 3 months. We're willing to take a loss, pull the trigger, and if you want to stay with that position, go out another 3 months. So if you have an NVIDIA option that was 200, went to 2,000, now it's back to 200. Well, shit, we just went on a roller coaster ride, and we're about to get nothing if it doesn't go up and it expires out of the money. So just close it, pull the trigger, and then go out another 3 months to see what you can buy. Now you might have to put more money into it. Obviously, $200 not gonna buy you much in the video.
Right.
But what you're doing is you're reducing your chances of losing.
Right.
Don't have your whole ass out there on the line if you don't have to. Bring back $200 and let's do another trade that gives you more time. Do another trade. Give yourself more time. Give yourself more time. Make sense?
Right. Lots of sense.
Now, we talked about Mr. Morgan. I want to just touch base on that, if you will. This is meaningful because what am I teaching you to do? I'm teaching you to reduce your chances of losing, bring in some money, pay some bills, right?
Right.
Sell some options. Either you're going to sell some options on your shares with the cover call, or sell some options on your options, which is a spread. Because what? So Mr. Morgan is this ideal character who we always have to be accountable to.
Right.
He's a dude, maybe from Texas, maybe from New York, doesn't matter, but he has old money. He doesn't trade himself. He hires traders, investors like you and me. And he has a big ass building downtown, right there on the face of it, Morgan Investments. And our job is we work for him. Our job is to make money, is to invest in the stock market, cover calls, we're buying Apple, we're buying Microsoft, etc. We're buying NVIDIA, right? Because it's going up and we're riding that wave. But here's the thing. He's trying to select the best investor, best money manager. And he just wants us to make money. He's not going to be like, doesn't care about how we do it. He just needs us to make money and we need to pay our bills.
Right.
So what I'm telling you, to get back $200, I'm trying to save your ass, because if you lose this whole position, if you get your ass wiped out on all these positions up here because you're so aggressive, Mr. Moore's going to fire you.
Right.
But if you can get a consistent income, you can get 480 for these Palantir shares every month. If you can get 122 on this Microsoft call, you can buy grocery money, electric bill. Mr. Moore's gonna be like, you're making nice money, Kerwin. I gave you $1 million and you already brought in like 200 or 300K. I'm gonna reward you. I'm gonna give you a black American Express Centurion card. I'm gonna give you a company card. I'm gonna give you full medical benefits. And what else do you want? You're negotiating. Time off, vacation pay. But here's the thing. If the market dips and all of these positions get wiped out and his account goes down, he's gonna take back his black American Express card. He's gonna take back the company card.
Right.
And he's gonna kick you out of the office.
Right.
So we need to have what? Results.
Yes.
So Mr. Morgan is really like our inner dialogue, ourselves. We can't make these big mistakes. We got to be very careful. We got to be a shrewd stock selector. We got to be making the money on these positions consistently. Right. We can't be out there losing the whole we can't be out there losing our whole position. We don't have that
Right.
luxury.
Agreed. Yes.
Questions?
No, I think pretty much covered everything.
Do you have any other positions you want to talk about on your account?
No, just got Roku. Right now.
Let me talk about Roku. So I'll be the first one to tell you that we got beat the hell up on Roku. Got a 2x4 of our head, but we can double down now. We can look at going out 3 months, which is like, so it's March, April, May, so June. I want you to think about if you can get a position for June. Why? Because there's 3 more months. You have time to trade. Put some money. Maybe we can bring some money back from these other positions. Buy a couple more call options on Roku, right? Now, I also spread my Roku, but because it's down so much, don't spread it that much. Like if it's 63, right? I think you can go to 100. I think you can go to 100. Right. I'm not going to do the spread for less than 100. Okay.
Right.
So if I'm doing spreads, it's going to be over 110, 150, 120. So write this down. June spread, sell 120, for example. Okay. Because what? If it goes to 120, it's basically double the share price. That's plenty of play, right? Whatever options you may have, right? See if you can double down a couple more for June. And then spread it. Why? Because we're going to have plenty of play if we can do whatever offer. We have 100 or 110. We can spread it to 120. Or we can even have like maybe a 95. Let's say, can you check one for me?
Yeah.
Can you check 95 for June? I'm starting fresh, not telling you to do this position, but I want you to think about it, okay?
Right.
Give me a price on the 95 for June call, and then also what's going to be the 120.
All right. Yeah, this is May, so June. The 95 was 260 on the ask.
Okay, $260.
No, I'm sorry. Okay. 153 on the 95. 153 on the 95, and then on the 110.
No, 120.
120. The bid is 37. Ask 42.
Wait. Okay, 195. You said 153. How much?
Yeah, on the 95s, the ask is 153. 153.
And then the 120 is what?
And then the 120, the ask is 42.
Okay.
Bid 37.
You see how it's 1/3? You see how I did that?
Yes.
Now, if you buy the 95 call, you pay $150. Okay, one call, 153.
Right.
And now you're going to get back, you're going to sell the 120. You're going to instantly get back $42. Okay. Right. So now we know that reduce our chance of losing. We're going to have some money back. But look at this. You have 25 points of play, or you have a call option worth $25. Okay. You buy a call option for 153. It goes to $25 at 120, which it could do. I'm not saying it will, but let's say it does do that. It does do so. It does great. After 120, it's a wash because you're short the 120. You're long the 95, and it's a wash after. So you're capped out at 120. But hey, $25 for 153, that's like what? If you divide that, that's like 8 times 8-fold, whatever it is.
Right.
Divide do 25 divided by 153. Can you do that?
Yeah.
25 divided by 153. 15 times. 15 full return?
16.
16 full return. Is that enough return? Is that going to pay your groceries?
Heck yeah, it is.
So the difference in this trade is that we're kind of going more out lofty. We're kind of like we're looking for like a grand slam, like a Hail Mary pass, you know.
Right.
But at the same time, we know what Roku could do. We know it was 108 just like a month ago.
Right.
So why couldn't it go to 120 this time, right?
Right.
So that's like a trade you might want to look at. One more thing. Can I do one more thing before we wrap?
Yeah. Oh yeah.
I want you in talking about reducing our chances of losing. You want to have some puts. Write this down. Puts. Look at QQQ 400 or 390, 390 to 400 puts. Why? Because all I'm doing is I'm taking 30% off the top of the share price. So if it's like 440 times 30% is like minus 120. You get like 330 or 320 price.
How far you want to go out on those puts? 3 months. So out to May.
No, let's go more than that, because when you do a put, you're doing like longer term as far as, you know, if you hedge the whole market, what are you doing? You're protecting your whole account. The difference in this trade is protecting your whole account. Okay. So can we go can we go out 5 months or 6 months? Can we go out 6 months? Is it you see in August?
There's no August. You got June, and then we got July, then it skips to September.
Let's do July.
All righty.
Give me a 320 put, not call.
320. I'm gonna have to open up more strikes. You want to say?
You should always have them all. You should have them on all strikes, always.
320 is 91 cents.
91 cents. Okay. So the value here is that if the market corrects, and we know it will dip at some point, these 91-cent options are gonna go bonkers. Okay.
All right.
$91. Okay. And it depends on your account size. Let's say, write this down, 2 to 4%. Write it down. Account size in put hedge. 2 to 4% of account size in put hedge. What am I doing? If so, you have, let's say 100K. You can spend between 2,000 and 4,000 and buy puts for 6 months out, 5 to 6 months out. Why? Because that's going to protect your account from loss in case of a crash, in case of a correction. And here's the magic of this. When I say 2 to 4%, we know we can get 2 to 4% on a cover call for 1 month.
Right.
I'm not telling you to get extra money that out of your pocket I'm just having you use some of the profit already to back up your whole account on a put hedge. When the market gets slammed, guess what? All these long positions are gonna go south, but your put will go up. So what happens is when your put goes up in the correction, you have basically 2 choices. You can sell your put at a profit. Write this down. 1, when market corrects, sell QQQ put. I'm doing QQQ, right?
All right.
At a profit, or leave it. Number 2, leave it, because if you sell at a profit, then you won't have any more. You won't have any more protection. Or you can leave it. When you think about leaving it, is like the theory behind it is like you don't want to be unprotected. You know, you can't afford it, right? So you just leave that there to the expiration. In a sense, I don't want you to let it expire, but I want you to, before expiration, 1 month before, I want you to roll it to another 6 months, right? But what are we doing? We reduce our chances of losing. If the market corrects, guess what? we're going to have some money back, Kerwin. We will have at least not our whole account will get wiped out. And here's the thing that you don't realize that when you write this down. You can trade this. Like the market can dip, cash out on the puts. The market goes back up, buy more puts cheaper. The market dips again, cash out on the puts. The market goes back up, buy more puts cheaper. So this is a cycle that these hedge fund managers been using since the beginning of time. They're trading the market. Look, the market's really going bonkers. We're at all-time high. Dow Jones, QQQ, SPYs are at all-time high. Buy puts now while they're cheap. When the market dips, and it will, sometimes it's just manipulation. They make it dip, right?
Right.
Cash out the puts. And then what happens? It starts climbing back up. Oh, look, it's going back up. Like it's cheap. Cheap puts are cheap. Buy more puts. Comes back down. Those puts go up.
Right.
So, trading the market, trading into these trends, into these upswings and downswings. And when you get that perspective, you're just doing it like automatically. Like if I'm in a grocery store picking potatoes or tomatoes, I'm thinking, man, my puts are gonna come in if that market dips. I'm gonna cash out, but pull the trigger. Remember, I'm gonna pull the trigger at a profit, and then let it climb back up, and then buy them again. Now, it's easier said than done because you can actually think it's gonna go back up, and you have no protection, and it goes down more. So you have to have that perspective, you know. You have
would you
to,
say?
you know, you have to have your ear to the ground, huh?
Right. Would you say have like 4 or 5 puts, and then as the market drops, you just get out of like 3 of them?
I always have something because if I have no protection, I have no calls, no spreads, no puts. My ass is out there ready to get what? I can't do that to Mr. Morgan's money. No way. You can take my ass out. You can take my black card away. So I always have something. Like, you know, and if the market does crash, and it will, you know, because it's been happening, you know, since the 70s. I've been in the market about since 88, I think. Man, all these crashes, you know, and people it's the same reaction. It's like, oh no, the market's crashing. You must be really, you know. And like after so often, you just kind of numb to it. Like, well, you know, I got some puts, so I'm okay. You know, I'm short all these cover calls. If you're doing cover calls and the market dips, if the stock dips, those cover calls give you some protection. Did you ever think about that? Because those calls you're short on, those go up. And it expires your position worthless, and you get to keep all that money. So a cover call is in a sense a hedge against a falling, some protection. You're still long. You're still, and that's the thing. Like when we talk about like long, short, you're still long on the cover call because you still want the stock to go up. But when it dips, hey, you know, that's a little bit of protection, gives you a little bit of money in there, and you get me?
Yes, I do.
I think we have a win today. I think we can wrap it up.
Okay, sounds good to me.
You have any further questions?
No, I'm good.
Think about what I didn't tell you, or what I can think about is pull the trigger. When do you pull the trigger? Because when you're in the profit mode and you'll pull a trigger, you don't ever get paid. You gotta pull a trigger and close your positions at a profit. And then what? You can, once you have the money current, once you close, you're good because now you have the money, you have a successful trade, you feel good as hell. And you can go back and reevaluate. You can say, well, let's see. I sold my Microsoft calls. I sold my QQQ calls. My Roku went up. I sold the calls. Now I'm going to just kick back and wait for a second. I'm going to reevaluate. I'm going to wait for the right time. Wait for the right time to trade, to do the next trade. Sound good?
Sounds good to me.
Thank you, sir. Next Sunday?
Next Sunday. I'll be here. Have a good one.
God bless.